What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you as always, I'm the people's champion of Wall Street, the bearded boy wonder, Dave Bartosiak. And today, my friends, it's the good, the bad, and the ugly, our weekly trade review. Now, we didn't do it last week because I was moving and there's all sorts of stuff. That's why you can see this glorious new spread I've got going on here. So we've got a lot to talk about, including a lot of the stuff that expired last week that I wanted to touch on, and also a lot of the stuff for this week now. So we're just going to go ahead and get cracking. We got a lot to talk about. So the first thing I want to talk about is this bullish call spread on Burlington. Burlington? That's right, folks. Burlington. We're going way back. So we were long the October 20th 90.95 call spread for $1.67 net debit. So max profit with Burlington over $95 per share. Now the spread was trading at $1.75 the last time we talked on October 12th, and I told you rip it near break even. Okay. Now, when I say things like this, you got to do it, because if you didn't, you would have lost the max here on Burlington, as that next week it didn't really pan out. So when I tell you go ahead and rip it as close to break even as possible, rip it as close to break even as possible, because if you stick around, you know, I can't be held responsible for what happens after I tell you to do something, basically, is what it comes down to. So, well, I can't be held responsible before then either. Either way you slice it, you know, you gotta get out of Dodge when we're talking about getting out of Dodge. Otherwise, you can be in trouble. So that's Burlington. Then we had a strangle on KB Homes. Now, this one didn't work out, but we knew this wasn't going to work out. Short to October 20th, 22.24 call spread and 22.20 put spread for $1.14 net credit. Max profit with KB Homes at 22. If you remember, this thing rallied and ran in our face. KB got all the way up to 27.08. So one side of this was a max gain, but the other side was the max loss. And that's what happens when you do a strangle or an iron condor, things like this. So in this case, it was 86 cents loss, max loss. Now, likely, if you're closing this out that day of or the day before, it was 85 cents or 84 cents or whatever it was. When you have a strangle or a short option, short call spread, short put spread, whatever it is, time is on your side, okay? So if it runs in your face right away and you can close it out in this case, like for an 86 cents loss, why are you solidifying that loss when you actually have a chance to gain some of that ground? So don't discourage if the day after an earnings report, the thing doesn't go exactly your way. That's why we don't do the day after expiration. We go out a few weeks. Time is on our side on a lot of these, so don't freak out. Nobody likes it when a trade goes against them, but don't compound that by making the mistake of hastily running for the exits. You got to sit and look, okay, what am I actually gaining out of this if I stick around versus if I just bail, okay? Message. All right, so now I want to look at the bullish put spread here on Adobe, ticker ADBE. We were short the October 20th 150-148 put spread for a 42-cent net credit. Max profit with Adobe over $1.50. That bad boy rallied considerably, closed at 175.64. It was a glorious trade, and max profit was achieved, plus that 42 cents, or in terms of what we had at risk, 26% on that trade. So a little bit more conservative, but a victory nonetheless. Then we're talking about Constellation Brands, ticker STZ. We were short the October 20th 190-185 put spread for a 120 net credit. Max profit with STZ over 190. STZ got all the way up to 211.25 at expiration. So nice little post earnings drift. Everything was great. Again, we maximized our profit as much as we can make there. Made $1.20, which was good for 31.5% based on the initial risk that you had put up there. Okay, so that was another good one. Then we had the third bullish put spread here. That was on Costco. Short the October 20th 160-158 put spread for a 40-cent net credit. Max profit with Costco over 160. And guess what? They closed at 160.77 on October 20th. That means this was a max profit, 40 cents or 25%. Remember what I said before about be patient when you're short a put spread or a call spread and it goes against you? Because initially this did go against us. Time was on our side. You just got to be a little bit stubborn sometimes. Now, notice that's different when you're when you're long a call spread or a put spread versus when you're short a call spread or a put spread. When you're short, time is always on your side. Okay, so there's that. So the last one here, a bullish put spread, again, ad nauseum, right? On Netflix, short the October 20th, 182.50, 180 put spread for a 50-cent net credit. Max profit with Netflix over 182.50. This one closed at 194.16. So that was, again, maximum profit, 50 cents in the pocket or 25%. So the bullish put spreads were quite well, did us quite well. And here I'm just looking at all of our October 20th expiration. I think I'm going to switch up the format so I do things like this from now on. Burlington was break even. KB Homes was a negative 86 cents. That was a loser. Adobe plus 42 cents, winner. Costco plus $1.20, winner. Netflix plus 50 cent, winner. So of the ones that we had open heading into this last week, pretty good overall there on October. Okay, now the bullish call spread on AMD. So we're going to go from the good to the bad, right? AMD, we were long on November 17th, 15.50 call spread for a 57-cent net debit. Max profit with AMD over 15.50. The report was good. They beat earnings, but the guidance, not so good. So the stock got beat up. The stock's down at 12.19 at the 200-day moving average. The spread is at 8 cents. Woof. But listen, you only have 8 cents at risk right now, right? You can recover 8 cents. 8 cents is all you have at risk. What's it going to cost you to close out this trade? Probably $8, right? Minimum. So at this point, when you're faced with this, you may as well just hold on, okay? And this is why we do call spreads, because even when you're losing, you're winning. Remember, even though we're long this 14 call, we're short the 15.50. So we've already hedged our bet coming into this. So when we're putting up these bullish call spreads, remember that we're already partially offsetting what we could have potentially lost, okay? It's all about managing your risk, and we manage our risk before this trade, so once you're in it, it's tough to manage it once you're already in it. The risk management takes place before you put your chips on the table, not after they're already on there. Then we've got a bearish put spread on pets. Here's another one. Long November 17th, 35.30 put spread for $1.42 net debit. Max profit with pets under 30. Pets skyrocketed after their earnings report, causing a lot of people to freak out and accuse me of being the worst person in the history of the world. Well, guess what? I'm not, because what happened? The spread's at 90 cents right now, with pets at 35.66. What you have to ask yourself when the market is spiking directly in your face on something like this, is this sustainable? And again, did I buy the next day expiration? No, I didn't. I bought some time value so we have a chance to get in the game for something good to happen, okay? This one spiked up and then came crashing right back down. Now it's at 35.66. So now what do? The stubborn may get rewarded on this one, but I just suggest cutting bait. Too much of a roller coaster ride for me. The stock spiking up and then crashing down. Sure, maybe it breaks down below 35. Just not worth it. I think there's just better opportunities out there in the world. No reason to keep that 90 cents locked up. Yes, it's a little bit of a negative, but it's much better than losing $1.42, just losing 52 cents. Okay? So there's a bearish put spread on pets. Then you have a bullish put spread on Domino's, DPZ. Going back to our bread and butter here, short the November 17th, 195 put spread for a $1.30 net credit. Max profit with DPZ over 200. Problem is DPZ is at 186.17, so the spread's all the way at 450. Again, what did I say? You got a credit spread. Time is on your side, so just chill. Hold it. Do you want to max? If you rip it right now, it's 450. Okay. The worst that this thing is going to get is $5, right? Okay? So put that in perspective. That's a little over 10%. So 12% worse it's going to get, okay? Or 11% worse it's going to get to the downside. Versus the chance that this could actually turn around and you're going to be okay. Remember, there are still risk management parameters that we put on this before you bought it. Sure, we're short the 200, but we were long the 195, so it offsets it, okay? So really, here, just take it easy. Just wait. Time is on your side. Even though it feels terrible, a lot can happen between now and November 17th. Then we have just an outright bullish call on Citigroup. Here we just went long the November 17th, $75 call for $1.72. The break even on this is 76.72. The call is trading at 73 cents with Citigroup at 74 and change. So we're still in the game here also. I say you hold it. Maybe next week, if we get a little bit of a spike, we can sell a spread, we can sell a 76 call, we can sell a front week call, whatever. We can manage this trade in the future because we're just long on one side. The reason that we bought this is because we saw that leading up into an earnings hike, or a rate hike rather, that banks have a tendency to rally. So that's what we're banking on here. Just hold it. We'll see what happens next week. Then a bullish call spread on PayPal, ticker PYPL, long the November 17, 67.50, 70 call spread for $1 net debit. Max profit with PayPal over 70. Spreads at 204 right now as PayPal has rallied considerably. So that's great. Now here's the thing, okay? I say you rip it for the double up. The most that you can make here is the difference in the strike prices, which is $2.50. You already made 204. Let's just call it 2 to make the math easier. So if you hold it for another 3 weeks, you have the chance to make another 50 cents on $2. So you can make 25%. Is it worth it to hold something for 3 weeks in order to get 25%? I don't think so. I think you rip it for the double up, go on to the next one, and just enjoy the profits. So that's all I got for you here today on the good, the bad, and the ugly. Tomorrow at 9 a.m. Central, we're going to be doing the morning after alphabet earnings. So we're going to cover the Googs. Whatever it does tonight, tomorrow morning, we're going to see how the market reacts and come up with some actionable trade ideas that you can do. Not just on the Googs, but whatever it is that's moving tomorrow morning, we're going to go ahead and we're going to jump on it. So don't miss it, 9 a.m. Central tomorrow morning. I'll send out the link in an email tomorrow. So thanks for hanging out with me here on Zach's Live Trader with the good, the bad, and the ugly. I will see you all mañana. Have a good one.